Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. How could a more restrictive monetary environment impact retirees and their savings? Taylor Tepper, lead editor of Banking at USA Today Blueprint, joins me for Financial Literacy Month to discuss. Taylor, it's great to see you as always. Welcome back to Trade Talks.
Thank you so much for having me. It's an honor to be here.
You got it. Why is it a great moment for savers?
Well, this is the first time in 15 years or so that savers finally are able to earn a little bit of interest on their savings. I think I was back in college the last time you could find a CD that gave you 5% yield. So this really helps people when they try to save for immediate things like maybe a down payment for a home or for a car. And it gives people sort of positive momentum because you kind of feel like the last 10 years, 15 years when the Fed cut rates after the great financial crisis, that people thought like, what's the point of savings? Or like my savings account only gives me like 0.3% APY. It feels bad. It had bad juju. I think this gives people some positive juice to get like the psychological encouragement they need to put money away and to be on top of their finances.
Conversely, it's tough for debt holders. What can they do to manage the load more effectively?
So this is a very important time to pay down debt. You know, it's great for savers. It's bad for debt holders. You got to come up with a budget, whittle down your credit card debt, really get that under control. Think about that in terms of savings. There's all different types of methods you can do about it. You can attack the lowest balance first. You can attack the highest interest rate first. Whatever strategy works for you, go after it. But this is really going to be more and more expensive to carry that debt. So you really got to work it down.
What makes saving for retirement so hard as it relates to replacement income?
So there's this thing called lifestyle drift, lifestyle creep. And basically it's kind of like feels bad because the more money you make in your life, you know, you're successful, you're doing great, and you get used to nicer things, bigger house, bigger car, more kids. It's wonderful, but your standard of living increases. And so even if you're saving like 15 to 20% of your retirement, which most people aren't, you are having to replace a much bigger portion of your income. You're always sort of behind when it comes time to have your fully funded savings account when you retire. So one thing that people like to talk about is really capping every single raise you get. So save half of every raise. If you save half of every raise, not only are you saving a lot of money eventually over time, but also you're requiring less money to live off of once you actually retire because you've gotten used to a lower standard of living than you would have otherwise if you'd just been spending that money. People don't like it when I say this, and I don't, I can't always live by this myself, but it's a really good goal to have for yourself.
Well, plus, I mean, people are living longer these days as well, so you have to make that stretch.
Exactly. You don't want to be, dependent on your kids when you're 99. You want to be able to sort of help yourself out. Although it'd be wonderful. I expect my children to feed and bathe me when I get older.
Yeah, something we all look forward to. Taylor, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thank you so much.